Let's bring in Jackie Porter, a certified financial planner with more. Jackie, appreciate you taking the time today. First of all, your thoughts on what the government is doing.
I really believe it's ill-advised because there's lots of stakeholders that you mentioned that aren't being considered, like investors, like retirees who are business owners who may need to access their income based via their shares that they built up in the company. And people who own cottages. There's lots of Canadians who are average Canadians who had a cottage handed down to them that they want to pass on to their children. How do they do that without facing a huge tax hit?
Yeah, I mean, the government is trying to portray this as, this is only going to affect the ultra wealthy. This is a tiny, tiny little percentage of Canadians. These are rich people who can afford to pay. But what you're saying is not so fast. Yes, that does include, but there are a lot of other people who are not the ultra wealthy and ultra rich. They're not millionaires, but this is going to hit them too.
Exactly. Let's not forget that small businesses, private-owned businesses, are one of the largest parts of our economy. They are the engine of the economy. They're the ones taking the risk, and there are very few ways that they can save. One of the ways they save is building wealth inside their corporations and creating shares that they can sell later. So this is a group of people who are definitely going to be impacted because they don't get that 250 exemption. They pay tax on the first dollar on shares they sell. So capital gains tax is basically paying taxes on assets you're selling. So basically you're taxed if you're a homeowner, if you're an investor who owns a second property, real estate, or you own public or private shares. So public shares being, shares of a public company, or private shares if you're a small business owner and you own shares that, one day after taking that risk and building the Canadian economy, you want to start drawing on some of the assets you built up in the company. Now you're facing a larger tax hit than planned.
I know that when this idea first came up a couple months ago, there was a lot of panic. People started to scramble. Some people wanted to sell those cottages quickly. No doubt your phone started to ring, Jackie. What are people saying to you?
Well, people are concerned. They really want to actually just work through different scenarios to see how potentially selling now or selling at death, how will these different scenarios impact the amount of income taxes that they're paying. So they just want to look at, tax efficient ways to do things like pass on their cottage to the next generation or potentially access their shares when they're ready to slow down. So these are definitely things that Canadians have on their mind. They are concerned with paying a little bit more. Let's not forget, like if you're somebody who has an asset that you bought for $500,000 and now that asset's $1 million, the first hit you're taking is $125,000 is going to get added to your income. So that's the first 250. But the second 250, and remember, small business owners aren't eligible for this. You're going to get an additional 167 of income added to your overall income. That puts you over earning 220,000, which means you're going to pay 54 cents on the dollar in tax. That all of a sudden you're losing to the government. So it's a major concern.
Yeah, nobody likes taxes. I think we can all agree. They are required to pay for social programs. We all know that as well. So let me give you a scenario here because it does get, yeah, exactly. It does get confusing because, you're talking about the inclusion rate and it goes from 50 to 67%, but not the first 250,000. Let me give you a scenario. If somebody is thinking about selling a secondary property, let's say it's a cottage, what is this going to mean for them, Jackie, if they don't sell it within the next 2 weeks?
Well, this is it. This is what I was mentioning is that first 250. So going back to that 500,000, right? Let's assume that's all capital gain. The first 250, 125 of that 250. Remember, 50% capital gains inclusion. So 125,000 is going to get added to that tax holder's income. And now on the next 250, you're going to lose 167,000. Not lose, that's going to get added to your income as well. So to know what your income tax bill is going to be, add 125 to 167, add that to and add your personal income, and then you're going to pay a marginal tax rate based on all of those income taxes.
So you're going to get hammered.
Get in touch with an advisor.
Yeah, you're going to get hammered, in other words.
Yeah, at 54%, because remember, once you have earned income over 220 in Ontario, you're going to lose 54 cents on the dollar. So it's a big concern, a really big concern.
Jackie, thanks for taking the time for us today. We'll see how this one plays out in the weeks ahead.
Thank you again for having me.
Yeah, Jackie Porter, certified financial planner, joining us from Toronto.